Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. We've got some exciting news to cover, including a major acquisition, new investment opportunities, and some corporate drama. So, let's dive right in. Let's start with Hotel Properties Limited, or HPL for short. HPL is a well-known property developer in Singapore, and they've just made a big move. They're planning to buy the Intercontinental Auckland in New Zealand for a cool $180 million, which is about $138.5 million. This is a pretty big deal for HPL because it's their first property in New Zealand and only their second intercontinental hotel. Their other one is in the Maldives, so they're definitely expanding their luxury hotel portfolio. Now, you might be wondering how HPL is going to pay for this fancy new hotel. Well, they're not dipping too deep into their own pockets. They're using a mix of a loan from a third party and some of their own cash. The good news for shareholders is that this deal isn't expected to shake things up too much financially. HPL says it won't have a big impact on their net tangible assets, earnings per share, or how they're doing overall this year. If you're holding HPL shares, you might be interested to know that they closed at 360 on Tuesday, up by 0.01 or 0.3%. That's a tiny bump, but hey, up is up, right? It's worth noting that this price was before the announcement, so we'll have to keep an eye on how the market reacts to this news in the coming days. Now let's shift gears and talk about the Singapore Exchange, or SGX. They've been busy cooking up some new investment options for us. On Wednesday, they launched their second batch of Hong Kong Singapore Depository Receipts, or SDRs for short. If you're scratching your head wondering what an SDR is, don't worry. Think of it as a way to invest in Hong Kong listed stocks right here in Singapore. This time around, SGX has partnered with Phillip Securities to bring us some big names. We're talking about tech giants like Xiaomi and Meituan, which are big players in artificial intelligence and electric vehicles. They've also thrown in Ping An Insurance for those interested in the financial sector. These SDRs are aimed at investors who are looking for good yields, so if that's you, you might want to take a closer look. Here's how these SDRs work. Each one represents a fraction of a Hong Kong listed stock. For Xiaomi and Ping An Insurance, it's a 2-1 ratio. That means each SDR is worth half a share of the actual stock. Meituan is a bit different with a 5.1 ratio, so each SDR there represents 1/5 of a share. It's like buying a slice of pizza instead of the whole pie. You get a taste without having to commit to the whole thing. SGX isn't stopping here though. They've got plans to add more Thai and Hong Kong depository receipts by the middle of next year. So, if you're looking to diversify your portfolio with some international flavors, keep an eye out for those. As for SGX's own stock performance, it closed at 13.20 on Tuesday, down 0.10 or 0.8%. A small dip, but nothing too alarming given the new offerings they're bringing to the table. Now, let's talk about some drama that's been unfolding at City Developments Limited, or CDL. If you've been following the news, you might have heard about the father-son rift that's been making headlines. Well, there's been a new development in this corporate soap opera. Dr. Catherine Wu, who's been described as having a long relationship with CDL's executive chair, Kwek Leng Beng, has resigned from her role at Millennium and Copthorne Hotels, M&C, which is a subsidiary of CDL. Now, this wasn't just any role. Dr. Wu was an unpaid independent advisor to the board. Before that, she was a director on the board from June 2022 to January 2024. This resignation comes in the midst of the ongoing dispute between Kwek Leng Beng and his son. The details of this family feud came to light in late February, and it looks like things are heating up. A hearing has been scheduled for April 11th, where both sides will present their evidence. It's like a corporate version of a courtroom drama, and we'll be watching closely to see how it unfolds. As for CDL's stock, it closed at $4.97 on Tuesday, down 0.03 or 0.6%. This was before the announcement about Dr. Wu's resignation, so it'll be interesting to see if this news has any impact on the stock price in the coming days. Now, let's take a step back and look at the bigger picture. What do these developments mean for the Singapore market as a whole? First, HPL's acquisition of the Intercontinental Auckland shows that Singapore companies are still looking for growth opportunities abroad, even in the face of global economic uncertainties. This move into the New Zealand market could signal a trend of Singapore firms diversifying their portfolios geographically. The SGX's launch of new SDRs is another interesting development. It's part of a broader strategy to make the Singapore market more attractive to investors by offering easier access to foreign stocks. This could potentially increase trading volumes and liquidity on the SGX, which would be good news for the local market. As for the CDL situation, it's a reminder that corporate governance issues can have real impacts on companies and their stock prices. It's always important for investors to keep an eye on these kinds of developments, as they can sometimes be indicators of deeper issues within a company. Overall, the Singapore market seems to be in a state of flux, with companies making strategic moves and the exchange itself working to attract more investors. As always, it's important to do your own research and consider your personal financial goals before making any investment decisions. That's all for today's Singapore Market Digest. I'm Iggy from the Investing Iguana, reminding you to stay curious, stay informed, and happy investing.